G'day everyone, Stefan and Tom here from Angel Advisory, another installment of the Real Wealth podcast. Today we're going to be looking at insurances, and the reason we've chosen this topic today is because recently, through a combination of friends and friends of friends, we've encountered three individuals who have had, I suppose, unforeseen circumstances take place where they needed insurances in place. One, a 43-year-old male who was unexpectedly diagnosed with cancer. Another 42-year-old male passed away from respiratory complications, and a bloke who works in construction, 40 years old, who's torn his shoulder apart and obviously not able to work anymore. The interesting thing with all three of these cases, all have two children, which means they needed a plan in place for, like I said, these unexpected circumstances. So before we get into it, thanks very much, Stephen, for joining us.
Mate, happy to be here. So yeah, life insurances, income protection is the important part when you can't work anymore, when these things happen.
Yeah, that's it. So we're going to jump into having a look at the different types, costs and structures of the different suites of insurances. Before we do that, do you want to bang out the disclaimer? Get the boring stuff out of the way.
Love this one. G'day everyone, Stefan Angelini here. Just so you know, anything you see, anything you hear here is just general information. Please don't consider it as personal advice. If you want any personal advice, please go and consult your licensed financial advisor. Happy days.
Cool. All right. So we'll probably have a look at those three case studies in a minute, but just as a demo, I want to look at the different suites of insurances and how there's no template that fits. I mean, you and me are both males, same age. The insurances that we would require,
very different.
Very different.
Yeah.
So given your position within the company as director, but also with your wife and two kids, what's required for you to plan for the future? Very different to what I would need.
Well, yeah. A lot more people hanging on me making money.
Yeah.
For the future.
Yeah.
So, where do you want to go from here?
So types, costs and structures, well, I suppose we'll kick it off with life.
Yeah.
And then just see how that relates to either you or me or the three case studies that we mentioned before.
Cool. All right. So I guess four main types of life insurance are life insurance, disability cover, trauma cover, and income protection. So life insurance. So what happens if you die?
Yeah.
Right. What happens if you die? Who is relying on you? Who's relying on your income? And if you look at, for instance, Stefan Angelini, I've got two kids. I've got a wife who is a full-time mother to those kids. And what that means is that her income earning capacity has dropped off and if I passed away, then she would be the full-time mother.
Yep.
I don't have a level of assets yet where I could sell everything and they can survive off it.
Yep.
So I need insurances to make sure they can lead the life I want to live.
Yeah.
So I've got considered in my life insurances, for example, I want my family to be able to live off a certain amount each year, call it 100 grand after taxes. I've got included in that, I want my kids to have the ability to go to a private school. So I've got that funding fixed into there as well.
Yep.
And as well as I want the house paid off. So all the debt absolutely paid off as well. So they're the main considerations that people come to us and think of. Now, when I've turned to talk about when you add back, like what don't you need? So I've added back so they would also get my superannuation payout.
Yeah.
Or they might also get part of a business sale if that comes through. So you can do add backs with when you've got life insurance, but basically when you think about it is who needs money and what do they need for the rest of their life when I'm not here?
Yeah. And an important part of that you just touched on, I think, would be when you talk about paying off the property, if you're gone and then that responsibility which you used to handle is suddenly thrown to Whitney, I mean, that's chaos if she's left to do it on her own. Yeah. When you set up the life insurances, it's designed in a way that this is taken care of. So we're not plucking numbers out of the air. We're calculating an amount that's required to pay off that debt. That's then factored in, amongst other things.
Yeah. Because if it's not paid off, they've got to sell it.
Yeah.
And then they're left with not much.
Yeah.
So that's how you work out. But for you, so can we tell people your personal situation?
Go nuts, mate. I'm an open book.
Single.
Yeah.
Ready to mingle.
Yeah.
Who do you need to leave money to?
Well, no one. I honestly would put a life through life insurance. Maybe as we get further down the line, some of them might become more relevant. But in terms of who I'm financially responsible for, it's me.
Yeah.
So if I'm not here, there's no debt to be cleared. There's no reason to take out that policy when no one's relying on me. I'm not feeding kids and saving for school. I'm glad I'm not saving for school.
Cool. So what's the other one that's
I think that would lead nicely into TPD because of the ability to link and the way that they sort of relate to each other.
Yeah.
Sorry, TPD, total permanent disability.
Yeah. So you can link TPD and life insurance because normally as a TPD, if you're getting paid out TPD, you're in a pretty bad situation anyway. So the best way I explain it is You get hit by the bus, but a bus doesn't do a good enough job. You're still here. You're still annoying people.
That's the best way to explain it.
Yeah, I think so.
It's brutal.
I think so.
Yeah,
It's not.
Gets the point across.
It's talking about life insurance. It's absolutely brutal.
Yeah,
I don't know how else to do it.
Yeah.
So you're here, you didn't do a good enough job. So what do you need? So a lot of times when you do disability cover, it's very similar to life cover, and you link them to each other because you want debt paid out.
Yeah.
But if your debt's paid out and then you die, well, you don't need it paid out twice because it's already gone.
Yeah.
So there's certain overlappings, which is why you might want to link the cover. The one thing that's different with total and permanent disablement is a lot of times you might get paid an income protection portion. So if you've got income protection set up as well and you're still here, your income protection is good enough, you get paid from your income protection. So that'll meet a lot of your ongoing cost of living with your TPD payments. And that's why your TPD can be a bit lower than your life cover because you've got that other cover there. But when the most important thing to think about is when you talk about the disability cover is the category and the ownership.
Yep.
So there's two main parts. There's an any occupation disability cover and an own occupation. Any occupation means if I can get retrained to do any job, then I won't get that payment.
Yeah.
Because you're not in that bad of a situation under that category. Now, that's what a lot of industry funds have in their wording and definitions. So it's really important to read product disclosure statements if you like reading 72-page documents that are completely boring.
Yeah.
Under the own occupation cover, if you can't do your own job, you get paid out the disability cover.
Yeah.
So it becomes quite important and very, very relevant for individuals, especially if you've got a specialist kind of job. Some people that we see have a very broad job, and they say it's very rare that I'm going to not be able to do my job.
Yep.
And therefore they might opt to have any occupation cover. But otherwise, it's a lot of people that lean towards having that own occupation definition because there's a high likelihood you're going to get paid out. So why not pay a few extra bucks to give yourself the best chance of actually getting the cover when you need it?
So that's for own occupation. Obviously, the more desirable one, which it's offset by slightly driving the premiums up.
That's it.
Yeah, it's the better deal.
Yeah, with anything, you want a better cover, you got to pay a little bit more.
Yeah, for sure. And again, to come full circle to us, TPD, I would say, is necessary for you.
I need,
not one I need.
Yeah, exactly right. So mine's got a bit of extra complexity to it. So I want to factor in things like getting really good healthcare in the event it comes out. So I've got a really, really big amount allocated for medical costs.
Yeah.
Also home modifications as well. So if, say I'm in a wheelchair, for example, at least I can fix up my house. I have the money to fix up my house.
You're putting ramps in, etc.
Yeah. I'm a business owner. Very tough for me to get income protection when you're starting a business the first few years.
Yeah, fair.
So I've had to have just a little bit of a allocation there as well because that income protection isn't quite there. So TPD is a lot higher than it should be.
Yeah.
From someone like me. And for you, like, it's still important.
Which one?
TPD.
Yeah.
You've got cost of living you need to meet.
Yeah.
I mean, unless you can rely on family and things like that.
I can. That is part of it. And also partly banking on the was it the train or the bus to just do the job? Just get it over with.
That's where everyone's different.
Yeah.
Everyone's different.
Put a maybe next to TPD for me. Which brings us on to the next one, which is trauma.
Yeah.
Which is quite niche and differs from TPD. What would you is that one that you require?
Yeah, for sure. So trauma is like a one-off. So it can also be called critical illness. So you have a traumatic incident. So there's a certain group of what you can cover for. So let's call it cancers, heart attacks, strokes, certain other things that fall into the categories. Pretty bad things happen though. And what this does is it essentially provides you a lump sum of cover to get through whatever time in that life that it is, right? Because if you're like me and you're debted up to the eyeballs and a lot of your cash keeps going out to pay for things, you don't have a heap of savings built up to the side there. And therefore you need something to pay you to get through those hard times. So what I mainly look at is I've looked at for the trauma cover, in the event something happened to me, I want to be able to pay for the best care. So I don't want to have to rely on the public system. So I've got an allocation for medicals. I've got an allocation to give me some time to take off work to replace what I get from the business or from a wage and not have to rely on income protection. I have to rely on the business paying me. Because I'm not actually involved. Because I might want time to recover. Because you might not get income protection if the doctor says you can go back to work, you're not going to keep getting your income protection. But then I've also got in my trauma cover, I'm a business owner. And this is where it starts to get a little bit more complex. I've got people relying on me. And if I'm the main revenue driver in my business, and I'm not there driving revenue and seeing clients and clients decide to leave, then I need to make sure that everyone in the business is safe and taken care of. So I've got an extra allocation to be paid into the business in the event something happens.
So in that regard, for you specifically, the life and TPD were quite focused on or tied to home and family. When it comes to trauma, you're looking more at how's the business going to continue when I'm not there.
Because I'm coming back. There's not something that's going to keep me down. You're going to come back from these things. Make sure everything's just safe in the while you're not there. So it's super important.
And last one, so income protection, I think both of us, yes. Although you're in a situation where it's not where it would be, where you'd want it to be. So in the future, what your income protection looks like will change.
What's the different definitions of income protection? Like things have changed so much in this space over the last 12 months because income protection became super expensive for everyone. And anyone that's got it, you would have seen your income protection premiums jack up a whole lot. Now there's a lot of definitions. But the main parts are, what is your waiting period? So how long will you wait before you start getting paid? So let's say you want to wait 30 days. If you wait 30 days, then you put your hand up and go, excuse me, can I start getting paid now? So that means you've got to rely on your own cash reserve or your sick leave to get you through for those 30 days before you start getting paid from income protection. Benefit period is how long do I get paid for? Do I want to get paid until I'm 65? Or do I just want it there for the next 2 or 5 years? Obviously, if you're going to get paid, if you're 40 years old and you want to get paid until you're 65, that's 25 years they need to cover for. So the cost is going to be more expensive, right? But the way those new definitions have come into play is they've said that we'll give you cover until you're 65, but we'll only give you the cover under your own occupation for those 2 years. But then you've got to prove that you can't work after those 2 years under our definitions or can't go back to work, and then we'll keep paying you. So it becomes quite tricky to get it. And that's why it's having the right conversations or finding the right provider for each individual. It's super important. The other main thing with income protection is how much can you get? So nowadays, so it used to be you could get up to 90% of your income, and then it dropped to 80. That's a long time ago. Then it dropped to 80. And now you can only get up to 70% of your income. So that's been a change that was implemented as a result of the Royal Commission into banking and finance in our industry. And it basically said that you need an enticement to go back to work. So if you're getting 80% of your wage,
why would you bother?
Why would you bother? So it used to be also you could get an agreed cover or indemnity cover. Agreed cover was no matter what happens to my wage, if my wage is at 150 grand a year and then it drops to 100, then I'll still get my insured value if it's above 100 grand. Indemnity now means that you'll only get 70 or 80%, depending on your product, of what your wage is within the last 2 years of you claiming. So definitions have changed. How you get the cover has changed, but it's really, really intrinsic. And whether or not you get like a plus policy that gives you benefits and gives you, it'll pay for your physio and pay for you to get better under like a plus or a premium policy, whereas some are just, we're just going to replace your income. That's it. We don't care. Just replace your income. What's right for the right person, it all depends on the conversation and what everyone wants.
And just throwing back a little bit to the agreed versus indemnity, there's no more agreed products on offer, is there?
No. You can't get them. And if you got them, it's super expensive.
And I suppose you just touched on finding the right combination for each individual. There's going to be, when we've had situations where the ideal situation is, well, I get paid out till I'm 65, of course. Why wouldn't I like that one? We run that, the premiums come out astronomical, and it's like, well, okay, I'm not going to, that's actually not as beneficial as I thought. 2 years, 5 years. And it's just a matter of massaging the numbers, waiting periods, benefit periods for what's going to suit each person. That's it. Cool. So that wraps up life, TPD, trauma, and IP. I suppose within those four, we now want to look at how they relate to superannuation, where they can be paid, where they can and can't be paid through super, essentially.
Cool. So you can pay for a lot of insurances through your super, as a lot of people would know. So you have an industry fund, and you get your payout from your industry fund quite quickly. You can get a payout from your industry fund, or you can have it within a separate insurance company, but it's still linked to your super. And that's beneficial if you ever want to change your super fund, you don't have to cancel your insurances. So that's what we do for a lot of clients. Now, life insurance you can have through super, and it's quite good because you get a tax deduction through super.
Yep.
When you pay for that life insurance cover. TPD, you can have basically without any occupation portion through super.
Right.
The one risk is that you will get taxed when it's paid out.
Right.
So sometimes you need to gross up for tax if you want to get the perfect amount.
Okay.
The own occupation portion, most of the time, cannot be owned through the super environment. Some providers allow it, but most do not.
Right.
Income protection can be paid for through super, but this is the risk. So it's great for cash flow to have your income protection paid for through super.
Yep.
The risk is that with a lot of providers, if you're not working at the time of your claim, then you cannot claim your income protection if it's paid for through super. So let's say you took a year off work,
Yeah.
right? And you were paying for income protection out of your own pocket.
Yeah.
Then you'd get that payment. You'd get that income protection payment.
Yep.
Even though you're not working.
Yep.
Whereas if you're paying for it through super, then you won't get the income protection payment.
Yeah, brutal.
The other thing is getting access to the actual income protection claim. So when it's through super, you need to meet certain definitions to get access to the payment, which becomes quite tough. And do you want to go through that tough scenario in the event you need to get access to that income protection payment? Through super, you get a tax deduction through your super, which is good. But even if you hold it personally, you get a tax deduction in your own name as well.
Yeah.
So I'm sort of touching off on taxes and structure.
Yeah.
The last one, so TPD, the own occupation, if you own it personally, you don't get a tax deduction. And with trauma cover that I spoke about, you can't own that through super. You can only own that in your personal name.
Right.
And the reason is because in the event you have a traumatic incident, you can't meet what's called a condition of release. So to get access to your super money, you need to meet a condition of release being a certain age, or you need it being financial hardship or something else that falls under that banner.
Yep.
But just having a heart attack or a stroke or getting cancer is not something that triggers that condition. And therefore it needs to be owned personally so that you actually get the money. There's no tax deductions for that either.
For trauma.
Now, the reason you might get tax deductions and you might not is because if the money comes through in your personal name under income protection, you will get taxed on that money. So therefore, because you get taxed when it comes back, you get a tax deduction for it. With trauma, you don't get taxed. So if you've got 200 grand of trauma cover, it'll come in and you get 200 grand that lands in your lap.
Yep.
An interesting thing on trauma cover as well is you don't need to prove the use of the funds at all. So we were doing with a client a while ago who got a $400,000 trauma cover payout and was meant to use it to get brain surgery. But she knew a surgeon who owed her a favor. The surgeon did it for free. So she kept the money, which is possible. So you just got to meet a release condition in your claim and you can get access to the payment.
That's a bad situation turning into a good one pretty quickly.
Yeah. And they're healthy, which is great.
So the surgeon was solid. It wasn't a gamble.
Yeah.
Speaking of the case study, so one that we encountered recently with bloke I mentioned before, so 40 years old, 2 kids, builder, and tears his shoulder apart. Then going through the process of getting the claim, the income protection claim, was tough because they come back with so many questions, clarifications, all these different things. And given that, I mean, we've seen it before, but he's seeing it for the first time and is sort of understandably saying, I've ripped my body apart. I can't work. It's so simple. Why am I getting more phone calls? Why am I getting more questions? But there's quite a few hoops to jump through before that income protection payment will come through.
Yeah, because you can imagine all the people that want to get the payment, but aren't actually that unwell.
Yeah.
So that claims process is super important.
Yeah.
And tough.
Yeah.
And tough.
Yeah.
And that's why it's important. So we, as advisors, we take care of that claims process for our clients who are under us.
Yeah.
Takes the stress off their shoulders, and that means we go in with our boxing gloves on and get to fight our way through to get the money back.
Yeah. The most polite fighting ever. So 2 things I suppose to take away from that is that is our role to take that on, to be on the phone constantly trying to push these things through, and also the concept of the individual assessment, which is there's no templated cover, same age, very different suites of insurances, and that goes for not just the 2 of us but everybody else. So getting that assessment right to figure out what you need and what's going to best suit you.
And for anyone out there, if you are someone that's now assessing insurances, or you have them and you think they might cost too much, or you're not sure about the structure, what they actually mean, reach out to us at helloangeladvisory.com.au. We've got a fairly detailed and quite simple process to figure out what you need, who's the best provider, and how to get you from end to end. And yeah, everyone comes out super happy with that. Well, not happy, because no one wants insurances.
No.
The necessary evil.
That's it.
Okay, cool. Well, mate, thanks for that.
Thank you very much.
All right. Well, thank you for listening.